Okay, I think we're up and going. Good morning, Larry, and thank you for joining us. For those who are not familiar, I'm thrilled to have an opportunity to sit down with a few minutes with Mr. Lawrence McDonald this morning. You can see his book in his background. You can also see a copy of it on my bookcase, How to Listen When Markets Speak. I came across the title of the book accidentally, became intrigued, read it, and reached out and have since joined the service. So why don't we start this morning, Larry? Just take a few minutes, tell us about the book, and then tell us about the service that you run for clients.
Thank you, Wally. Happy New Year to you and everyone, and I hope you have a blessed, healthy, productive, abundant 2025. Let's have an
Thank
abundant.
you.
So what we did on the first book, I was a trader at Lehman Brothers. It was a New York Times bestseller. And I tell my wife once a month, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock. So we did 140 speeches in 16 countries over the last decade, for 16 years. And we built this wonderful group of people. So when you go on the road, you actually make about 10 times more in the speaking tour than you do writing the book. But the best part is the people that you meet on the road. So we met a lot of talented hedge fund, mutual fund, pension managers, people like yourself around the world, high net worth advisors. And we have a chat behind me on the Bloomberg terminal where the investors pay a price to be part of that kind of private club conversation during the day. And then it's kind of like crowdsourcing information. It's where we're looking at trends in the market, but then we're discussing the happenings with really incredible investors that are running billions and billions and billions of dollars. And then we take that intelligence gathering and we put it into the Bear Traps report. We come up with a model portfolio, trade ideas. And I just live by the words. I live by the words, there's no I in team. There's no I in team. And you can get everything in life that you want if you just help enough other people get what they want. And so the book, When Markets Speak, or How to Listen When Markets Speak, is really a kind of a recap of the last 5 years of being on the road, sharing that intelligence in a book with a broad audience. And so it's the book and the Bear Traps report, and we're happy to be here.
That's awesome. And I think that'll be a kind of a great transition. I'll get Larry's put together a slide deck here for us so we can kind of get this up and walk through some things. But before we get started, Larry, one question I would have for you is, what was the biggest surprise you had in 24? What was the thing that you look back and said, boy, 24 really surprised me because of?
Well, I'm shocked that the Biden team was able to spend that much money on the fiscal side. And Kevin McCarthy and the Republicans opened up the floodgates for spending. I guess it was in the year before, in the summer of 23. And the way they juiced the spending into the election was really dangerous. I could see why they did it. They were trying to prevent a recession, but that really, kind of, I think, set the stage for much more sustainable inflation. But it caught a lot of economists off guard because the economists were looking at, traditional economic data, and they were kind of like hit over the head with this massive fiscal injection that really, all the leading indicators were pointing toward recession over the last year and a half, 2 years. And we just never went in because of that huge fiscal spending.
Every action has a reaction, as we shall see. So I'll let you kind of, one of the things that I think is really key in the themes of your book, Larry, and your writings. And again, you lead me here, and I'll jump around where you want to. But I think the thing you just talked about, inflation. And look, I think there are two things that people need to understand. One is the demographic argument, and there's a lot of great work that's been done on that great deflationary boom that we had was because of the demographics in the world that allowed us to do that. But the second thing is this changing of the supply chains. I personally think globalization has gotten a bad rap, but this move that's going on in America, and not just America, where it's bring it back to Germany, make it in France. It's going on all over the world. This shortening of supply chains is going to be one of the things that continues to make inflation, I think, higher. And by the way, sometimes shortening supply chains is a good thing. I think the idea that we don't manufacture active pharmaceutical agreement here in the United States is ridiculous. So we got to be willing to pay for that.
Absolutely.
But it leads to sticky inflation. So if that's okay, why don't we start with that and you tell me what slides you'd like me to take a look at?
Well, they're ordered in a pretty, I think the first one kind of goes into, we're trying to measure sticky inflation. So what happens in election years, Wally, is that, and I wrote about this in the first book. In an election year, the party in power will massage the data in their favor. So one of the things about 2008 is Bush was trying to really protect the party for McCain and Kudlow. I know a lot of these guys. I know them all, and because I've been a CNBC contributor for over a decade, and these people were just massaging the data. And so in 2008, everybody had a false sense of reality, and that's why we were surprised. The media was downplaying, the risks of the mortgage market on a regular basis, and they were being coached by the White House to do that. It's similar today, where the Biden team knew they had an inflation problem in 22. They did a number of things to try to contain it and get it down. The Fed helped, but the data on the inflation was massaged lower than reality. And at the end of the day, there's a lot more inflation than meets the eye. And now we've cut interest rates, Wally, 100 basis points with a 50 basis point cut in September. Biden, in the first quarter of the new fiscal year, just spent another close to $800 billion of deficit spending, up 38% year over year. So you have massive rate cuts, massive fiscal, and then now you have animal spirits from Trump. So as you can see here, inflation's come down, but it's really kind of trending back higher. Even though we had some decent data this week, we feel, and remember that the numbers this week, Wally, was December numbers, and in January we've had a huge move in oil and gas. So the probability of an inflation bounce is really high. And to get back to your point, Wally, about supply chains, this is what we talk about in the book. It's a multipolar world, right? And so we've had really extended, elevated conflicts in the world. It's a multipolar world. That just means a planet with more global conflicts, taking ships around Africa to move products and gas and oil around. It's just talking about much more inflationary pressures because of those supply chains that you were talking about before.
Yeah, absolutely.
Now, here's core services, less housing. So we've come down nicely since the summer, but we're still, look at that, what I call the lost world. We're so far above the previous highs. You know what I mean? And what happens is from 1968 to 81, the market was pretty much unchanged, but commodities really boomed. And when inflation gets sticky, it gets under the carpets. And what happens is you need a whole new portfolio construction for an inflation era versus a disinflation era. And in a disinflation era, you want to be in growth stocks, you want to be in the NASDAQ, but in an inflation era, you want to be in companies that own assets that can protect you from inflation. So to us, Supercore is not coming down that much, and we're still way above where we should be.
And Larry, just with your experience in fixed income, setting aside the argument of financial repression that you and I had offline, what should be a normal real rate of return that the market, what do you think investors are going to do? I mean, I know there was years when we had modern monetary theory, but But normally, what if we're thinking about the long end, the 10-year, what kind of a real rate of return should the market expect out there?
Exactly. So the Fed, for the last 15 years, distorted the true natural cost of capital. And now, because of inflation, they're forced to let that have a more natural rate. So I think on the 10-year, for example, we should be at least at 5%. And the problem is there's so much more debt now that was sold. Think of like all of 2017, all of 18, all of 19, all of 20, and all of 21. There were just trillions of dollars of debt sold to, in commercial real estate, in all kinds of housing loans, and all kinds of treasuries. And so there's just hundreds and hundreds and hundreds of billions of dollars of losses on that debt. And so the Fed has to be, I think, in a sense, the Fed is cutting rates with high inflation now because they're trying to prevent a financial crisis, even though inflation, as you can see here, look at the Bloomberg Commodity Index. So we've cut interest rates 100 basis points into this kind of, inflation bounce. And so that just tells you how much the Fed is concerned. Interest on the debt is now, as most people know, a huge portion of the budget, and they're trying to cut interest rates to really contain some of that risk in the market with companies that are exposed to higher interest rates, with commercial real estate, and with the interest on the debt at the federal level.
Well, the other thing, Larry, that's so interesting to me is we had the opportunity of a lifetime to issue 30-year paper at 2.5%. And
right.
and the real irony is, and this for all your fixed income experience, that's why the municipal market looks so much better than the treasury market, because municipalities, if you go into the municipal bond inventory today and look around, you'll be stunned about the number of 20-year 2.5% coupon. I mean, municipalities did the right thing. They went out, they do have their costs borrowed at below the rate of inflation. Meanwhile, we were issuing all this short-term paper up front. It made no sense.
And so when you talk to people that have talked to or that are close to Scott Bessent, now Scott, if you go back one more time, I just want, so Scott Bessent, he's really, really, he's the incoming Treasury Secretary who was on the Hill this week. And behind the scenes, the Trump team and Bessent is extremely annoyed with Yellen, because what she did was, imagine if she had issued $2 trillion of longer dated bonds, say 20-year bonds and 10-year bonds in the last year. Those bonds would have moved violently in price in an election year, because as interest rates go up, bond prices go down. But what she was able to do, the RRP had a lot of money. It's called a reverse repo facility. It's complicated, but all that means is there was a lot of money in the RRP, and money market funds buy T-bills. So take a guess, Wally. Well, I'll ask the audience. Take a guess as to how many treasuries were issued last year. And I'm talking about bills, T-bills, which are short-term, and then notes and bonds. And the number comes out to 26 trillion were issued last year because of all the 3-month bills, all the 8-week bills. And so what Yellen did was, in a very clever but dangerous way, she issued a huge amount of short-term T-bills. And guess what, Wally? If inflation surprises to the upside, T-bills don't move in price. So imagine 2 trillion in T-bills. No matter what happens to rates, no matter what happens in the world, because they mature in 3 months, 6 months, a year, they don't really move. Whereas 10-year and 20-year bonds move violently, right? And so what she was able to do is she took bond volatility out of the election year and she placed it into 2025, because Scott Bessent's going to come in and he's going to have to, what we call term out the debt. Trillions and trillions have to be sold, in 5 and 10 and 20-year bonds. And what that's going to do is it puts a lot of pressure on the global bond market. And essentially the prediction, what I'm hearing from our institutional clients, is the Fed's going to get forced to NQT, quantitative tightening, early and that's really good for commodities. And so you can see here, this year, commodities are the top, it's early in the year, commodities are the top performing asset class. Gasoline has made a big move. Obviously, commodities there made a big move, gas. And so, as you can see with both of those charts, CPI is understated relative to what's happening in the commodity market this year. And the CPI for January is going to be out in obviously in February.
Do you think it's reasonable that we settle out in a 3 to 3.5? Do you think 3 is a reasonable expectation? 3 to 3.5
on CPI?
Yeah.
No, I think it's going to be closer to 4, 4.25. And there's just too much in the supply chain problem, too much in terms of commodities. At the end of the day, like I said, they cut rates so aggressively. And here, look at this, artificial intelligence. This is one of the most bullish sectors. I mean, gas prices are up a lot. I'll give you an amazing stat. That I got on a call yesterday. Let me just pull it up here. You had, okay, so American Electric Power, every year they make a guess on the demand, the future demand for gas. And we're talking about data centers, we're talking about artificial intelligence, we're talking about all these drivers. In 2022, this company, AEP, American Electric Power, they thought the global demand over 10 years was going to be 1.5 gigawatts, 1.5. And then in 23, they told us 4.2 gigawatts. And now last week or the week before, they said it's going to be 9 gigawatts. And so the amount of demand for natural gas and uranium and a lot of these estimates on artificial intelligence are complete fantasies, Wally, because there's no energy infrastructure to support it. And so that's why
kind of like the fantasy that EVs were going to be 50% of sales in 2027.
Yeah, it's exactly. EVs, I mean, they use a lot of silver, solar panels. And so a lot of the infrastructure, the energy infrastructure, materials infrastructure that's needed for artificial intelligence, for electric vehicles, for Bitcoin, Wally. Bitcoin mining or globally crypto mining is using the same energy as South Africa now. And if Bitcoin doubles, it's going to be using the same energy level as France. And so this is a real potential energy crisis, materials crisis coming at us in the next 5 years or so.
Larry, I've been thinking about this recently because with all the hype and excitement of NVIDIA and everybody else in the pick and shovel space, but we were very fortunate to make just and you find out where these data centers are going to be. That might be an area investors ought to be thinking about looking at.
Yeah, Energy Transfer, for example, ET.
Yep.
It's dramatically outperforming the NASDAQ. And there's a lot of the sneaky trades. Right now, we love the oil services companies. You've got Schlumberger. Schlumberger is making the same amount of money today as they did when oil was at the highs in 2013, the same amount of money. And oil is down a lot. I mean, oil used to be over $120 a barrel. As you can see here, this is fascinating, Wally. So the United States of America is in a war essentially with Russia, in the Ukraine. We gave the Ukraine $100 billion. And we have a CIA, we've got intelligence, and there were these 75 vessels that were moving oil around the world for Russia, and we never sanctioned them in an election year because we just sanctioned them after the election. And I think the team Biden was afraid of creating, a real inflation spike. So what they did last week was they announced that all of these 77 ships or 75 ships that are moving Russian oil into black markets and, to get around sanctions, now we're going to go after those ships. As you can see here, oil's made a big move. Trump wants the pain for oil as far away from the midterms as possible. And the drill, baby, drill, we're way behind in terms of CapEx. Weatherford, Schlumberger, I think they're big winners the next couple of years because we're so far back in terms of exploration and investment. If you take the one thing we talk about in the book, Wally, if you took the 2009 to 14 path on investment in oil and gas and materials and uranium, we're essentially $2.5 trillion behind that pace. And that's the whole bunch of reasons for it: regulation, sentiment from companies. Companies want to retain capital and pay dividends. So what's going to happen in the next 5 years is Trump's coming into office. We're going to have much more exploration, a much better environment for the services companies. So the OIH, the SLB, or think companies like Weatherford.
I think, Larry, one of the things that I had pointed out to me by a friend of mine who trades oil and hedges, works a lot in the industry, was that in the gut slot low of COVID, and I think, and I could be wrong on the date, but I think he gave me April 24th of 2020 was the lowest day of economic activity in the world. You had basically every airport shut down. I'm here in St. Louis. I could drive 20 miles and see 3 cars on a road. I mean, it was the world was at a stop. On that day, we used 74 million barrels of oil.
Oh my God.
So the people that think that we're going to get, I mean, I always use that as my base case, is how much oil demand we could take. We use 74 million barrels of oil.
That's a great step.
The day the world was shut down, or the highest shutdown. So I think that's a kind of a good thing for us to keep in mind here. And I think one of the things that you do a good job in the book to talk about is the importance of energy, and not just oil, but natural gas and nuclear is going to have to be part of that discussion.
Exactly. And this is where we get back to the NASDAQ. The NASDAQ, since Christmas Eve, or like the 23rd of December, about $1.2 trillion has left the NASDAQ. And it's gone into a number of things, some global equities. It's gone into natural gas names. It's gone to rare earths. And these other markets are so small that if now think of the NASDAQ 100, it's almost 26 trillion in size, right? So 10 years ago, the energy sector and the NASDAQ 100 were about the same size, about $4 trillion. Within the last 10, 15 years, they were about the same size. And now the NASDAQ 100 is worth 26 trillion, and the energy sector is worth about $3 trillion. So the energy sector is down almost $1 trillion, maybe. I'm giving rough odds, but rough numbers. But the bottom line is the NASDAQ 100 has gone from 4 trillion to 26. Energy stocks are down, and now energy as a percentage of the S&P. One of the stats from the book that we talked about is in 1981, when we came out of that real hard asset decade, energy, materials, and industrials were 49% of the S&P 500, and now they're about 12 to 13%. Call it 13%.
Yeah.
So the theory of the book is we're going back not to 49, but those groups are going back to maybe 25, 30% of the S&P 500. And where's the money going to come from? It's going to come from the NASDAQ 100.
So, and I'm going to keep looking at your slides here, Larry. But as we think about this, I think this is another one saying the same thing. One of the things that help us for investors, and if you think about a conservative investor, and you think about the themes of your book: higher, longer, structural inflation, energy is going to be more important, kind of a rotation back to commodities. If you think about 3 buckets of money, a conservative investor who, let's say their benchmark is 30% stocks, 70% bonds, and then a balanced 50-50, 70-30. We think about those traditional models, and I've given you some insight as to some of the things that we've done when we think about within those sleeves. But how should that conservative investor, that moderate, and that aggressive investor be thinking a little? What else should they be thinking about in terms of their allocation that they haven't been using the last 10 years?
Well, one of the big problems for investors is the people can't see some of the risks. So the top three stocks are the highest percentage of the market. I think it's like 13, 14%, 13% of the S&P is in the top like 3 or 4 names. And that used to be 7% or 6%. But what's happening is, so in other words, when people are in a passive mutual fund, the passive mutual fund, well, if you go back to Microsoft for just a second, so one thing I want to, the passive mutual funds, this is why people need Wally Sparks. They need advisors because everybody's gone into these even the risk, you said risk tolerant versus conservative. A lot of people are in the net, what we call passive mutual funds. There's a lot of risk in them because you've never had that kind of concentration of risk. Now look at what's happening here. The dollar's been strong because of high bond yields, and Microsoft has 50% of their sales outside the United States. And so the dollar is knocking Microsoft down. Also, we've got higher inflation, like I said, higher bond yields. Microsoft's almost unchanged for 1 year during what's supposed to be this artificial intelligence revolution. And another thing about Microsoft is this year they're going to do 30% of their sales. It's going to be in capital expenditures in artificial intelligence. And
with no visibility of return on asset.
Right, exactly.
Or return on investment, excuse me.
It's like a arms race between all these guys. And it's like a scene from The Sopranos where everybody's holding the gun up. And even though there's no return on investment, people are just spending because they don't really know for sure what's going to happen. And so Microsoft's earnings are going to get really hammered this year, next year, because they're spending $80 billion on investment. And think about the last 10 years, Microsoft had a very, very modest, conservative capital expenditure budget. And now they've gone, all in. And so that's a really telling example of what's to come.
Do you want to touch on a couple of these that are kind of in the commodity space to give an idea as to the type of things that you look at?
Yeah, so Vale is just, a major commodity producer. It's a Brazil-based company. Brazilian stocks have been under a lot of pressure. But if you look at the last commodity move, so right now the CRB or the commodity index is starting to outperform the S&P. The last time that happened, Vale was up 100% in 6 months. You can see those bounces off the green circle. And so Brazil has an election next year. We've had a big revolution in our hemisphere. Trump, the fall of Trudeau, Melee, market-friendly candidates are coming in. The probability that Brazil kind of follows that trend is high. And once again, you want to own companies that own assets in the ground, nickel, iron ore, copper. And so Vale is trading, Wally, with a 12% yield, a free cash flow yield of almost 10%. And it's trading at only 2 or 3, a little bit less than 3 times EBITDA. So great buy here, good long-term buy. And then as you can see here, China is going to do a deal with Trump. As you can see, it's a triple top underperformance versus the QQQ. But you can see there that negative divergence. That's kind of a bullish sign for Chinese equities. And, a lot of people are starting to look, forget about China, just emerging markets. If the dollar rolls over, and we think it's going to this year, and we can get into that, you want to start thinking about emerging markets again.
Yeah, I think that's we're starting to hear some talk from our folks we use who are saying who've not been in that camp for a long time to begin. Of course, no one wants to look outside the United States right now because that's been death to have done that from an investment perspective. I think this is just another example of a broad commodity market.
Yeah, so this uranium down here, I think, is a screaming buy. All of this artificial intelligence, they're going to need small modular reactors. India, there's 1 billion people in India. Wally, that don't have air conditioning. We've taken 5 million jobs out of the United States. We've moved them around the world, and we're actually increasing the energy consumption of many countries, and those countries need nuclear power. China is expanding on nuclear power. Europe, Japan, United States is going to massively ramp up nuclear power. So in the book was a whole chapter on nuclear power, but right now the Sprott ETF is cheapened up a lot here. It's coming off, and so relative to commodities, you want to be buying some uranium down here.
Well, I think it's look, the other thing is, if you think back, the small, I mean, we have decades of experience of that. Think about what those reactors on those aircraft carriers, how many that would power a small town. So
right.
So it's not ridiculous to think about those things, that may well be part of the solution. And I think that
you can put them underground. You can put them underground. You can, there's just so much smaller than a nuclear facility, and you can put them in the countryside. And so you're not going to put them in neighborhoods, but
right.
But the dollar move here. So think about this. There's two wings inside the Trump team, the White House. There's the Don Jr. JD Vance wing, and then there's Elon and Bissent and the other guys. And so the populists in the Trump team are very, very upset about this move in the dollar, because it's decimating the Rust Belt, it's decimating U.S. manufacturing. And we know that Trump wants a weaker dollar. After he was elected in 2016, he came out talking the dollar down. The dollar's made such a big move, Wally, that the euro is down almost 8-9%. The pound, the yen, they're all down. But energy prices are up 16-17% for oil, 60-70% for natural gas. So the U.S., if you're in Europe in the first quarter, second quarter, they're going to get a big inflation shock because of this strong dollar. And energy importing countries are going to get really hit with inflation because their currencies have cheapened and energy prices have gone up. It's a double whammy. So the probability that those central banks become a little bit more hawkish relative to the Fed is high. At the same time, we're issuing so many treasuries. Like I said, Bissent has to term out the debt. And as he terms out the debt, he's issuing more longer dated bonds. That forces the Fed from, out of QT potentially into QE. That's dollar negative. And then at the end of the day, I talked to a person yesterday, a client of ours, really close with Trump. And he's like, they're going to announce the tariffs, but they're going to be out in September, October, November. And the countries are going to have a long time to comply. So the bottom line is the move in the dollar relative to tariffs looks fully priced in. And the probability that we have a reversal in the dollar, from the first quarter on for the rest of the year is high, and that's really good setup for commodities.
Absolutely. Historically, it absolutely is. I'm going to kind of jump ahead here, Larry, to be respectful of your time, but just to get a kind of a broad sense of some of the other conditions that you see that are important here, and then we'll wrap things up here.
Yeah, this is really important because this is animal spirits, right? So this is inflationary. So look at how the business confidence on credit conditions, in other words, business owners in America, they're more confident of credit conditions now than when the Fed started hiking rates. So normally when the Fed hikes rates, as you can see on the left side of the screen, after you get through a hiking cycle, credit conditions should be collapsing, right?
Yeah.
But here we are, we hiked rates a lot, and credit conditions are more easy, Wally, than the way he started hiking. This gets into animal spirits. People believe Trump and and this is very, very inflationary. This gets back toward, an inflationary bounce.
So, Larry, help me understand, because one of the things that I've watched over my career, and when I've ignored it, it's cost me a lot of money, is the high yield spreads, and so over treasuries, and why do you think they have remained so stubbornly tight? 280 over, which is just ridiculously cheap when I think about the risks that are around. And do you think those spreads will ultimately have to blow out before we have something really bad happen in the markets?
Okay, Wally, President Biden in the first quarter of the new fiscal year just spent close to $800 billion in deficit spending. Like it's up 38% year over year. And so the fiscal spending is really, really supportive of credit spreads because it's a lot of government jobs. And so the credit cycle, even though there's higher rates, a lot of credit managers are getting a nice return. There's a lot of demand for bonds because the yields are high. But even though the spreads are tight, the yields are relatively high compared to the way they were the last 20 years. So if you're a credit fund manager, you feel like you died and went to heaven because you're getting a much higher nominal yield than you were before. So that on top of the fiscal has just created this like really, really tight environment. Yeah, we think because Biden spent so much in the first quarter, the Trump team is going to be forced into some type of austerity in the second half of the year. And the probability that high yield spreads really start to widen out is high. And as you can see here, foreign buyers of treasuries have increased since I guess the last 3 or 4 years because those yields on US treasuries are so high. And that's been a big surprise, even though we need a lot more. Remember, we're selling a lot more bonds now. So even though foreign buyers have increased because yields are higher here than in many parts of the world, we have so many bonds for sale, Wally, and it's going to be, can't emphasize enough what Janet Yellen did by issuing so many T-bills. That's going to be termed out. And wait till you see on that, I think on the next slide. So you see how this is this year's issuance. So issuance explodes in the first quarter. And that's the debt maturity by month as a percentage of total debt. And so 25% of US debt is rolling over this year. 25% is trillions and trillions of dollars, but most of that's in the first quarter. So you get a big sell-off in the first quarter in bonds, but then toward the end of the year, there's a lot less issuance. And once again, this goes back to this bond crisis that's brewing. Inflation sticky. They have to issue a lot more longer dated bonds because they've been issuing T-bills. That creates, kind of a bond market crisis here in the first quarter.
That's great. And let me just say again, we appreciate and we'll post this, but as all the individual ideas that Larry's discussed, those may or may not be appropriate for any individual investor's portfolio. That's what you need to come back and talk to your advisor to say, how does this fit in my plan? But I think what Larry's encouraging us all to think about is those asset allocation models, whether you're conservative, moderate, aggressive, need to look a lot different than they did 10 or 15 years ago. And despite all the apprehensions around, I think there is good news here. We're primarily, most of our investors are bond focused as opposed to equities. And it's good news. We have now real rates of return. There was a long time where we didn't have that. So, it's funny. I tell my clients, we pray for your bond prices to go down. We want your bond prices to go down so we can buy more, because if we could get a surprise in the 10-year, and no one can forecast the rate, but if it would try to go to 6%, think what that would mean for high quality. I would personally rather own the debt of JP Morgan than the US Treasuries. And by the way, speaking of what they think, they just came to the market yesterday with a 20-year deal, 6% coupon, non-callable for 2 years. So that tells you what JP Morgan thinks, about what the debt curve is likely to look like. So, again, thank you for writing the book. Thank you for your time and service. And just to our clients who are watching this video, know that I'm reading Larry's stuff every day. We're discussing it within our group. And that's another arrow in the quiver that we're factoring into our asset allocation decisions that we're making for portfolios. So